Welcome back to the Dividend Diplomats YouTube channel. You know you're wrong with your boy Bert, the Hurt, and Lanny, the Dividend Diplomats. And guys, we're here to talk to you about not one, not two, but three dividend stocks that I'm currently on the lookout for.
That's right, everybody. But before we jump into this, you know the drill by now. Please subscribe to our channel if you haven't already. It's easy. Look below the video. See the little subscribe button. Click that button. We appreciate it, everybody, in advance. Thank you. If you haven't already, give this video a thumbs up so we can keep pumping out content, keep growing our channel, and keep helping Lanny, me, and everybody else reach financial freedom.
You said it, Bert. And, again, the diplomats want to send out our, obviously sympathy out to Ukraine and what's going on out there. Obviously, it's causing a little bit of chaos, obviously from a stock market perspective as well. The market has stayed down over this past week, down about 0.5% till just still over 4,300. Still looking for the week where it falls below and stays below 4,300. We're not too far away from that, but we're still going to be putting out content, still showing you what dividend stocks Bert and I are looking at each and every week. You can catch us on Twitter because we usually put out some hot takes. Obviously, these videos, we try to put them out as live as possible, but there's always a couple-day lag. Yeah. So again, we're here to talk to you guys about other stocks, three stocks specifically here today.
Yeah, and I think that's the important thing to remember with this too. It hasn't even just been what's going on in Ukraine that's been causing the market to have some turmoil. It's been inflation before that. It's been raising interest rates from there. We're long-term dividend growth investors, focus there, underlined long-term. We try to buy stocks that will perform well through good times and bad, to have that long-term track record. So when the market does hit some turmoil, earnings may fall a little bit. The dividend's not threatened. They've increased their dividends in good time and bad. So that's why we're always looking on the hunt for these long-term growth stocks, and opportunities like these in the market where the market continues to stay down oftentimes present some great opportunities for us to buy some of those long-term assets.
All right, guys. And we're going to get right into it. Obviously focused on the three dividend stock metrics. One, net price to earnings ratio against the S&P 500, which is currently at about 25 times earnings. And that really shows you if a stock could be undervalued against the market as a whole. Second, we look at the dividend payout ratio, preferably below 60%. Obviously below 60% really puts out safety in that dividend for them to continue to not just pay it, but we're passive and financial freedom, income investors here. So we are looking for them to be able to still grow it in the future. Third is that dividend growth rate. We don't want some stock like 3M that barely nudges their forward income by 0.68 to 1% every year. We need a strong dividend growth rate and a history of growing dividends.
3M wasn't even outpacing inflation before inflation rose there at this rate. So yeah, you're absolutely right. That's why we focus on the dividend growth history. And then there's that bonus metric, the dividend yield. After we look at the first year, we always look at the yield. Yield doesn't drive our decision. It never should, but we'd be lying if we told you we didn't consider dividend yield in some capacity in our purchase.
You lied to me, baby. Oh, you lied. Remember that song?
How could I forget? And especially your version of it. Well, maybe that one I'd want to forget, but I'm not exactly a great singer myself. So Lanny, is it time to let them know? Let them know what the three stocks on your watch list are?
Guys, finally, we're going to dive into the three undervalued dividend stocks. All right, Bert. So first on the list here, obviously no preferential order. We are going to look at Cummins, ticker symbol CMI, the big manufacturer, the big machine producer. Again, you've seen them on the highways rocking that logo for Cummins. Obviously, you can't forget it once you see it here on the screen. But they've had a very tough last 52 weeks. They're actually down about 24%, Bert.
Yes, they have, Lanny. They have had a very bad 52 weeks, and down year to date, they're down nearly 8% there. So it's actually in line with about where the market is trending year to date. But the last 52 weeks is obviously down because the market absolutely crushed it last year. And you already own some CMI, don't you?
Yeah, I own about $6,500 of CMI. So, I'm always looking to say, hey, Do I swing for the fences and get this position to $10,000? Obviously, I'm still a long ways from there because I've had a lot of appreciation run up on Cummins because they've been a great performing stock over the last handful of years. But let's get into the metrics, Bert. They're trading at $202.04. Again, they're down mightily from that last 52-week, this time last March by a significant amount. But those forward analysts to look in the price to earnings ratio, that first metric, they're thinking there's going to be $20 in forward earnings. So you do the math, it's pretty easy. 200 divided by 20. You got a 10 price to earnings ratio, Bert.
Well below the S&P 500 that you said is right around 25x earlier. Easy discount compared to the market.
In the words of Jim Carrey, I'm looking and I'm liking.
All right, well, let's see if you're liking this second metric here. The dividend payout ratio, their annual dividend is $5.80. Divide that by the 20.12 earnings per share. I don't need to tell you guys. We can quickly do this one. That's a 28% payout ratio that easily crushes the 60% threshold that we use in our stock screener. You must be liking that too, Lanny.
Hey, McDonald's, I'm loving it. So that's the second metric, the payout ratio. To get into that third dividend stock metric, the dividend growth rate. They've been boosting the dividend for 16 plus years. And they have been outpacing or pacing at least with inflation with the DGR of about 7.11% over the last 5 years. So can't argue against that either.
Nope, and they're well on their way to becoming a dividend aristocrat. They're less than a decade away. They've increased that dividend for 16 consecutive years.
That's right. But Bert, what's that dividend yield look like if you were to buy them right now today?
Man, it's so close to 3%. It's at 2.87%. So great levels for Cummins right there, a 2.87% dividend yield.
Guys, stock that's been punished in the market this year and last year. Undervaluation right now on all the metrics. Yeah, they took a stunner, bounced up, fell into a rock bottom. And then once they turned around from that, the taker tombstone happened. So again, to wrap it up, yeah, they have a 10 PE ratio, a payout ratio below 30%, and a dividend yield approaching 3% with a strong track record of dividend growth.
That is awesome. Hey, again, I see why you're on our watch list, but let's check out the other two companies on there. Dividend stock number 2, they might go back and deliver that nice Hogan leg drop to Cummins right there, because the second company is Leggett and Platt, ticker symbol LEG. We've been talking about this company for a long time, though. This shouldn't shock anybody that it continues to remain on your watch list right now.
Now, let me tell you something, brother. When Leggett and Platt came in, ticker symbol LEG, their stock price has been down over 20%, brother. But listen, not just that, but Jack, they're down 10% this year alone. Way more than the S&P 500, brother. So what does that first metric look like, Macho Bert?
All right, Hulkster, let's jump right in here. Their last stock price of $37.30. Divide that by the 308. Man, you're not going to need too big of a calculator for this one. It's a PE ratio of 12.11, Jack.
Wow, 12.11 price to earnings ratio for LEG. Oh, man, he even did the Mr. Perfect toothpick. Because, guys, that second dividend metric, that payout ratio is safe. It's perfect. It's actually at 54.55%. They pay a dividend of $1.68. Taking that over 308, they're under 60%, between 40 and 60%. Solid. Bert, what's that third metric look like?
All right, 5-year dividend growth rate, 4.39% there. So very solid, slightly below inflation this year, but outpacing inflation before the previous year. And their years of increasing dividend, they're always on that aristocrat, king cosplaying. It is insane. They have a very long-term track record of increasing that dividend there. Tell us about that dividend yield.
So their dividend yield has swelled. It has swelled. And you could actually have caught Leggett maybe in the 35, 36 range sparingly over the last week or 2 weeks. But their yield is a solid flat 4.50%, or well over 3 times the S&P 500, which currently yields about 1.3 to 1.4%.
Fantastic. Let's look at it here. Let's summarize this quickly. PE ratio 12.11, payout ratio 54%, 5-year dividend growth rate, 4.39%. Long-term track record of increasing that dividend and a yield of 4.5%. I mean, the metrics look phenomenal for Leggett and Platt. There's nothing more to say for that. I easily see why it continues to remain on your watch list, and it's going to be making an appearance on my watch list as well. Brother.
Love it. Love it. Well, guys, it's time. Fine. No, that wasn't good enough. Fine. Guys, you guys all need to give this video a thumbs up because finally, Starbucks is back on the dividend stock watch list. Ticker symbol SBUX. This coffee machine loving, this coffee house, this ambiance feeling, wheeling, dealing, coffee pouring. Are you snoring watching this video? Stock is actually down 23% year to date. So they've actually are down more than the other two stocks we talked about. Starbucks is a growth stock, but also I would call them a heavy dividend growth stock as well. So Bert, what does the stock price look like? What's that first real metric, man?
All right, price $90.03. When it started the journey of popping up on your watch list, it was at $95. A couple weeks ago, it popped down to 85 for a hot flash, and it's bumped up a little bit. Still at 90, well below that 52-week high price as you highlighted. Their forward EPS are $3.91. That gives you a PE ratio of 23.03. So a little high, but for Starbucks historical standpoint, that's cheap. Also, growth stock too. You remember that growth stocks have that higher PE ratio versus some of the legacy companies that will have the lower PE ratios.
Now, Bert, I know you love this. That second metric fits right in your tool shed because what is that dividend payout ratio for Starbucks?
All right, $1.96 divided by that forward EPS of $3.91. That gives you a perfect payout ratio of 50.13%. You know what that earned it, Lanny, right there? Little blue meanie action right there, right?
When Bert busted out the blue meanie, let's just say the girls go crazy here.
Yeah, that's absolutely right.
We're about to call it, Blue Bert meanie. You guys let us know in the comments the nickname for that one. Yeah, man, he's even wearing a blue fleece. Oh man, he's just repping.
Yeah, tell us about that third metric here, Lanny.
Well, the third metric's interesting now because they're on the double-digit growth, history streak. Now they're at 11 plus years of doing it. And guys, they've been doing it at a 16% clip. Average increase is 16%. Starbucks, I love it. I love your coffee. I love what you do to the communities. Let's go, man. Let's go. But Bert, now has the yield crossed that 2% threshold?
Well, with a stock price of $90.03 and an annual dividend of $1.96. You bet it has, Lanny. You absolutely bet that the dividend yield has crossed 2%. It's at 2.18% at its current levels. Yeah, you fall back. You go slamming against the wall over there, brother. That's right. We're coming in here swinging. We're coming aggressive. Starbucks 2.18% with a 16.055-year dividend growth rate. Holy freaking cow. Lanny, summarize these metrics before I get out of my chair and flip the table here.
All right, guys. We first had Cummins, ticker symbol CMI. They had a P ratio at 10, a payout ratio below 30%, dividend growth streak of 16 plus years at a rate of 7%, yielding almost 3%. Leggett and Platt, LEG, 12 PE ratio with the perfect payout ratio of 55%, growing the dividend as an aristocrat. So well over 25, 30, whatever plus years at a rate of about 4 to 5%, yielding now 4.5%. Bert, what was that Starbucks metrics that we just went over?
All right, PE ratio 2303, perfect payout ratio 50%. It does not get any more perfect than that, Lanny. 5-year dividend growth rate 16.05, 11 years increase in that dividend in a 2.18% yield. All right, so here's the thing. I know we talked about how you own some of CMI earlier in there too. Do you also own Leg? Do you also own Starbucks too? And let us know, Lanny, do you have a preference, a ranking of 1, 2, 3 from this watch list?
All right, guys, my lowest position right now is Starbucks in my portfolio. My wife actually owns a lot more than I do of Starbucks, but I would be interested in, I'm at 2.8 thousand. Yeah, I'd be interested in grabbing a couple more shares, maybe, either 2 to 7 more shares, either getting it to 3 or 3.5. Leggett and Platt, I own about 3.7 thousand. Wouldn't mind grabbing another 10 shares of Leggett just to try to get it to about, 4,000 even. Cummins, can't go wrong. Again, I think you can't go wrong. I again, do your own research. We're not investment advisors, but I think these are all 3 dividend stocks to buy right now.
Excellent. I agree. All 3 are fantastic companies. The metrics make sense for each. But everybody, let us know, what do you think of the 3 companies on this watch list? What do you think of Cummins, Leggett and Platt, StarBucks? How many do you own? How would you rank the 3 on this video? Or do you have other stocks that you'd put on your watch list ahead of these 3? Please let us know in that comment section down here below this video.
If you haven't already, definitely smash that subscribe button. Give this video a nice thumbs up so we can reach the millions and millions of dividend investors out there, and all investors. We are all pursuing financial freedom. Bert, any other parting words?
Nope. Time to send these candy blanks home, Lanny.
That was Bert, and this was Lanny from the Dividend Diplomats. Over and out.